Welcome to this explainer. Today we're diving straight into what I'd honestly call a masterclass in supply chain efficiency. We're looking at how Arju Rice Mill is solving major B2B payment headaches with a fully automated, integrated settlement engine. If you've ever had to deal with B2B payments, you know it can be an absolute nightmare of delays and manual accounting. But what Arju has done here in Nepal is fundamentally rewire how money moves from a consumer's pocket across an entire supply chain in mere milliseconds.
Okay, let's take a quick look at our agenda. We'll start with the credit collection problem, look at Arju's national resolution flow, break down the central settlement engine, see the automated distribution of funds, and finally, check out the real-world business benefits. Let's just jump right in.
Part 1. The credit collection problem, or as I like to call it, the industry bottleneck. So I want you to ask yourself something. What is the absolute biggest bottleneck in global supply chains right now? You might be thinking, oh, it's logistics, shipping containers, maybe raw material shortages. Well,
for the folks actually managing the books, it's something way more fundamental: simply getting paid. The traditional model relies on constantly chasing down invoices, dealing with, honestly, painful manual reconciliation, and suffering through these endless credit days. If you've ever had to hunt down a missing payment, you know it literally takes years off your life. Money just gets stuck between the retailer, the distributor, and the manufacturer. Cash flow freezes, and businesses suffer. All right, moving on to Part 2, Arju's National Resolution Flow, focusing on tech-driven solutions. This right here brilliantly illustrates the big picture. Take a look at Arju Rice Mill's National Credit Collection Resolution Flow. It's a completely unified system integrated directly with Nepali banks. You can see how a single payment starts on the left, flows through aggregators straight into a central automated settlement engine in the middle, and then, bam, fans out to multiple bank accounts on the right. This isn't just a simple payment gateway, it's a whole ecosystem built to totally replace that awful invoice-chasing process. To really wrap our heads around the mechanics of this, we're going to follow one single payment through 4 distinct steps. First up, customer initiation. Second, gateway processing. Third, the engine calculates the splits. And fourth, final account settlement.
that brings us to Part 3, the central settlement engine, which is really the brain of this whole operation.
So, our journey kicks off at Step 1. A consumer, or maybe a business in Nepal, initiates a payment for Arju rice products. And they aren't doing anything complicated on their end. They're just doing a standard QR scan, paying through an online portal, or using an app. Super frictionless for the buyer, right? But behind the scenes, it kicks off this highly sophisticated automated chain reaction.
Next, at Step 2, that payment hits an aggregator or gateway portal. Now, this portal is unified with various Nepali banks, including the Nepal Clearinghouse, or NCHL. This is a critical step, because the gateway doesn't just securely process the transaction. It actually acts kind of like a detective, instantly identifying the exact distributor and the specific order attached to that payment.
And here is where the magic happens: the trade terms and agreement database, sitting right inside that central engine. Once the gateway identifies the order, this database instantly looks up the predetermined rules. It's checking the specific distributor or wholesaler terms, verifying exact margins, and pulling the agreed-upon split percentages for that exact transaction. Basically, it's doing the job of an entire accounting department in a fraction of a second. Crazy, right? All right, let's look at Part 4, automated distribution of funds, where we see how this money actually gets routed. In mere milliseconds, literally the blink of an eye, that single customer payment from Step 1 gets sliced up and routed into 4 distinct destination bank accounts. We've got the Arju manufacturer account, the regional distributor account, the retailer or wholesaler account, and crucially, the government taxes and fees account.
Let's zoom in on how those funds are actually divided. On one side, the Arju Rice Mill manufacturer account, which is held at a partner bank, gets direct payment for the core product cost and the mill's margins. That means no more waiting 30, 60, or even 90 days for the distributor to cough up the payment. At the exact same time, the regional distributor's account instantly gets its cut. Their specific commission and logistics costs are deposited straight into their own bank account.
And it doesn't stop there. Simultaneously, the retailer or wholesaler account receives an instant settlement for their specific sales margin,
Plus, here's a piece of true operational brilliance. The government taxes and fees account automatically gets the VAT and tax deductions. Nobody has to manually withhold taxes or, furiously calculate VAT at the end of the month or stress over compliance errors. The central engine just handles the whole shebang right at the exact moment of sale.
Which brings us to part 5, the business benefits and the real impact on the bottom line. First and foremost, we're talking about instant credit collection. By wiring the payments directly from the consumer all the way through to the manufacturer's bank account, Arju Rice Mill effectively just deletes the need to chase invoices. This drastically reduces those outstanding credit days and pretty much wipes out the risk of bad debts that usually absolutely plague the FMCG supply chain. Second, this setup gives everyone full transaction visibility. Because every single split is automated and routed through that central engine, you get real-time tracking and reporting for all parties involved. The mill, the distributor, the retailer, they can all pull up their dashboard and see exactly where their money is, confirming that their margins have been respected and instantly deposited. Finally, this entire flow hinges on seamless bank integration. Because the gateway aggregates through entities like NCHL and various Nepali banks, the automated reconciliation is just flawless. It entirely removes human error, the classic mistake of matching the wrong payment to the wrong order, and it saves accounting teams across the country literally countless hours of mind-numbing spreadsheet work. So we've seen how seamlessly a single payment can cascade through a really complex supply chain, settling margins and taxes instantly. I want to leave you with this final thought. If a rice mill in Nepal can completely automate their financial visibility, integrate flawlessly with a national banking infrastructure, and basically wipe out bad debt in the process, what on earth is stopping your industry from doing exactly the same? Thanks for joining me on this explainer, and keep looking for those brilliant operational efficiencies.